Welcome to OpalesqueTV. Today I'm in Las Vegas together with Sosikian from Pinnacle Quant. We are actually together here at the SALT conference, the 10th anniversary Skybridge Alternative Investments Conference. And Rafi runs a S&P 500 E-mini strategy that I think is really worth looking at and worth discussing. I think it's really unique. So Rafi, before we go into the strategy, tell us first about your background. How did you get started? What did you do before trading?
Yes, I'm an entrepreneur. I call myself more of a techpreneur. What I've done is right after high school in '94, I built a website for a directory that I'd written called the Your A to Z Directory of Government Grants and Loans, which I basically went to the library and got a bunch of information and put it together in a big book form and put it on a website. That website had to be, of course, coded, front end, back end, and it had to be optimized so that it comes up higher on, at that time, search engines like Yahoo, Alta Vista, all the web, because Google wasn't around and it came into the scene in '98. And so I did that for a while. Business plateaued. It was doing really well for a while, about $10,000 a month on average. Did that for about 2 years. But ultimately, there is no moat around businesses like that. So what happens is they copy your book, they do it at a cheaper level, and pretty soon you get priced out. And so when sales started to flutter down to about $2,500 a month, I said, let me get a job. I had just graduated college, got a job at Bank of America. This is where my partner there was a guy named Roger Rodas, who some people may know. Roger was unfortunately in that fatal car crash with Paul Walker from the Fast and Furious movies. But Roger certainly explained a lot, showed a lot of passion about what he does, and that passion rubbed off. So I had that in the back of my mind always. But soon after B of A had been merged with Nations Bank, we were making a lot of money as a department, and they decided to cut the commissions. And so when they did that, a lot of people lost incentive to keep working there, and so left, including me. And so I left, and I started from scratch this optimization business that I wanted to try to see if it would work. And it was honestly, after 8 months of developing that website, it was a tremendous success. It started off slowly, and then it grew into ultimately a 17,000 client database, and so it did really, really well. At some point, I was really competing against Google AdWords particularly. Their team we would have a lot of sort of back and forth with them. And so, we're going after the same clients ultimately. And so, soon after this, I decided I have a little bit of money. Let me go ahead and see if I can build my own search engine. So with a shoestring budget of $1.3 million, I started a company called SosBuzz, Inc. Also, I wanted to mention with respect to SosBuzz, which is a very complicated search engine to build, I was able to get a patent on it as well, on certain elements, the most important elements of the search process. And so that I'm sort of proud of, because it's a very crowded space with tens of thousands of patents for every element and every aspect of search. So to be awarded a patent from the USPTO on this was a big thing for us. And so I just felt that I should put that out, that I'm pretty proud of that.
So you have a very deep technology background, and you moved then into trading futures. And obviously you weren't intimidated by the financial world or by the complexity of trading financial instruments with leverage and all of this at all, right? And finding your signals. So tell me more about this transition.
Basically, what I simply did is just study the markets. I went through all of the equities first. I went through everything in the S&P 500. I looked at gold, I looked at oil, I looked at the DAX, I looked at various different things. And finally, when I came across the S&P 500 E-mini futures, I said, this is something that I easily spotted the patterns. It was harkened back to the days of when I used to spot the patterns of Yahoo and Google and their algorithmic changes, how I can manipulate that to rank my client sites higher. It was pretty easy for me to see those patterns because they repeat over and over and over again throughout every keyword and throughout every website. And so I saw the same thing happening with the E-mini S&P 500 futures, where I didn't see that with the other products, whether it be regular stocks like Apple, Microsoft, etc. I didn't see it in oil because that's more news-based. You have tremendous spikes and there's no real pattern. And so I found it, however, in the S&P E-mini 500 futures. So what I did is I said, okay, let me go through and try to find everything over a longer period of time. So I was looking at, let's say, I think it was at a year and a half or 2 years. I said, let's go deeper. Let's go all the way down to 2008, even a little bit before that, 2007, sort of the tail end of 2007, and see if, in fact, I'm right about this. And so what I did is I started now, based on what I observed in the patterns, the price patterns, I started to develop code around it. And it's done in C#, so it's fairly easy compared to the search engine, various different languages and front and back end that you have to know. So this is a lot easier, relatively speaking, to coding from a coding perspective. And so basically I just went through it and codified what I saw. And then once you run it through and you back test it, going back to 2008 at least, until whatever present time you're in, then you can make a determination as to how well this did. If it did well, but there were some days that it was off, the right way to do it, unlike what I've heard at this conference and other places where they use machine learning to try to figure out if it's right. So they basically try to track it in increments from the start to the end of the trading cycle without a human being really intervening to see exactly why that trade failed. I decided to actually do it one at a time. So if there was a failed trade, let's say it's an 80% win rate, but that's a hypothetical, of course, but the 20% of the time it failed, I wanted to know why it failed that 20%. So you had to literally look at every time it failed. This could be hundreds of trades as to why it failed one by one and figure out exactly why it failed. And literally that requires Googling what happened on this date. And because there's probably news that made it fail. And usually, a great majority of the time, that is in fact the case. So now, right now, today, last week, we still have what I call the double T threat, which is the Trump tweet threat. So a simple tweet can very quickly change how the market's going to end that day. So that is an important thing for me. It was an important thing for me to discover up front as to what's going to happen. So I had to then build pricing structure, stops, figure out what the right rate, the risk to reward ratio is, and proceed further. So I hope that answers your question.
So Rafi, how does the strategy actually work? It's E-mini futures, but tell us more about your signal generation, your holding periods, and some other parameters.
So that's a great question. So the way I looked at this was to say, okay, we need a systematic way to trade. We don't want to trade where there's emotion involved. And so systematically, I have to develop a system that will price me out correctly so that I can have the right entry, the right target, and the right stop. So the signal, in essence, is, I guess if I were to make it as simple as I can, is a buy to dip strategy. And so what it will do is it finds lots of different support levels, and once it finds those support levels, there's a bunch of constraints that it's going through, thousands of lines of code of constraints, where if it passes through all of those filters, then it takes the entry. So I'll give you a very quick example. Let's say we have a price bounce off of the yesterday's low. Doesn't mean we're going to take that bet, because you could right above you can have resistance of the initial balance open, for example, and you would have right there a resistance where it would go up half a handle or a handle and reverse right back and cross below that prior low. And so we have to be careful. There's a lot of constraints like that, a lot of constraints that are built into the system that are looking for trades, not just to take, but to avoid. So it basically goes through a bunch of filters. Ultimately, it enters the trade. When it enters the trade, there's two legs. So the first leg has about a 1.4 ratio of a risk to reward. And the second leg has a 1-to-3 ratio. And so the first leg has, just to quantify it, has 50 tick price target with a stop of 35 ticks. The second one has 115 ticks to a 35 stop. So, and also as far as the time frame goes, it is an intraday system, so we are out at the end of the day no matter what happens. In fact, people here were asking me like, what happens if, I guess they're worried because I'm a one-man operation, so they're worried about their planning, contingency planning. So like, what happens if, the internet connection goes off? So I go a step deeper. I say, well, I have several internet connections. There's 2 computers. There is a replacement part for everything in the computer available. The computers have UPS batteries, plus I have a power generator on site, so if the electricity were to go down for long periods, we have electricity, nothing's going to go down. And what happens if I die, if there's worms coming out of my nostrils, there's vultures eating at my eyeballs, it doesn't matter. The system is going to be exited at the end of the day. And so the intraday time frame is usually on the trades. Different years on average will have different results, but I can tell you that it averages between 60 minutes to like 90 minutes, right around that range, where it basically takes an exit. And there's another thing that I should mention. So we don't wait if price has gone, I don't wait. My system doesn't wait when price has gone against us. So if, for example, price goes in my direction and then it hits a known resistance number and it goes back a little bit, withdraws just a little bit, I don't have to wait. I can exit immediately, book my profit, and if it reverses and crosses that resistance again, we can always re-enter the trade. It's a much safer way of doing it instead of waiting and saying, no, I'm going to wait until I hit my 50 tick target, and all of a sudden it goes to 48 ticks, and I'm sure this has happened to every trade, and it goes all the way back down and takes out your stop. So on both sides, I have that type of protection. There's a bunch of exits on the win side, a bunch of exits if the price is going against us. So some of the exits, for example, if we bounce off of a support number, we hit a resistance number, it starts to go down off of that original entry support number, I will take the exit. There is no reason why I should wait to take that my 35 tick loss when I can take a 7 tick loss. So there is no reason for that.
So Rafi, how long have you been trading this and what are the results?
So I traded the system live for approximately 3 months. The results were, in my view, very good. So I had 29 trades, 28 wins, no month where I had a drawdown, and net of my 35% performance fees, 10.52% return over those 3 months.
Was this in line with what you expected from your back tests?
So very good question. Back testing is very, very important for me. I wanted to be sure that whatever system that I come up with is going to work, going back all the way to very, very bad times like in 2008. And so the back tests were pretty much in line. It's, when you back test anything, it's always going to be better. No matter how you toss the dice, the back test is always going to be better than the actual results. But I would say I'm off probably about 10%. So it's not a stark difference, as you mentioned, but there is definitely a difference between the back test and live.
Rafi, what is your capacity limit? How much can you trade with your strategy? And then secondly, are you working on something new? Are you also developing a new strategy along that?
The current system probably can take a capacity of $25 million, but it's probably pushing a little bit. Therefore, I've put my sort of a limit on myself where I said $10 million. Considering that the market margin to equity ratio is around 30%. So essentially, you're going to have to put in 10K for every contract that I trade. And so it's about $10 million in its current state. But I am, of course, you always have to be working on new strategies. I've built the leg system that I mentioned earlier for that reason, where the infrastructure is in place already, where I can fairly easily, in a fairly short amount of time, be able to scale this thing so that it can handle really the maximum capacity of the E-mini S&P 500 futures, which I don't know if people that are watching this may or may not know, but it trades approximately 1 million contracts a day. It is highly liquid. Of course, there are limits to how many contracts you can hold at any given time. I believe that limit is 300,000. And so they're going to have some regulatory limits there, exchange limits there. At this time, I'd like to focus for example, the $10 million that I mentioned. as you may have seen on my website, I actually want few number of clients. I don't want a lot of clients. Unlike everybody here I've met, in fact, everybody I've researched online, they want to, as many clients as possible, as much institution money as possible, as much foundation money as possible. I actually want a few number of clients that are going to be with me for a long time and really build up the business where I can show my performance results on a consistent basis, and then if I run into the right institution, the right foundation, et cetera, who wants to go a lot bigger than 10 million, which is nothing to them, then it would be ready where they can trust me enough to say, I want to take a bet with this guy and see if he can scale the strategy that he's got into something bigger where we would be in and out a lot in a long period of time than 60 or 90 minutes, right? So I'd rather remain small, but have a very small number of clients that are very happy with me, that are staying with me, and hopefully one of them will be a big client who'll say, you know what, I started with this guy I'd never heard of before, and now I'm very happy with the results. I want to bet with him to see if he can build me something that is a lot more than 10 million, and see if we can do something together there. That is my strategy. It's a long-term strategy, and I am really, very patient when it comes to that.